Hi, I'm Tim Courtney, Chief Investment Officer here at Exencial Wealth Advisors. I manage the Exencial Global Relative Value Strategy, which is a strategy that invests across several diverse asset classes. Included in those are assets like real assets, such as real estate, both in the United States and internationally, commodities, things like gold, precious metals, assets that tend to hedge inflation risk and tend to have better returns when inflation is higher. It also includes equities globally, mostly in the United States, but also including companies all across the world, large, small, and emerging markets, getting exposure to thousands of companies across the world. And one of the things about the strategy, one of the reasons why it's called relative value, is it tends to buy and own more of those companies that are trading at lower prices. And it tends to overweight companies that have certain characteristics that historically have been shown to have higher expected returns. So companies that trade at lower prices have historically had higher expected returns. Smaller companies have tended to have higher expected returns than larger companies. Companies that have higher profitability have tended to have higher expected returns. And then there are factors such as momentum that are also included. These are characteristics that academics have identified that not all the time, not in every quarter or every year, but historically over longer periods of time have had higher returns. And we tilt our portfolio to own slightly more of those names. We still do own lots of large companies. We still own companies that have tended to trade at higher prices. But we have tilts in the portfolio to tilt towards those areas that studies have shown to have higher expected returns. And so it's a very well diversified portfolio. We hope to smooth out the performance so that that investors have maybe a smoother and lower volatility behavior in their portfolio returns, and well diversified so that it's hedging several risks that are always affecting the market. So one of the goals of the portfolio is to smooth out the returns so that we own multiple asset classes that are behaving differently at different times. Some will be outperforming, some will be underperforming, but together as a group we should have a very diverse set of assets providing hopefully a smoother return. And one of the ways that we accomplish that is we're very on purpose about rebalancing the portfolio. We know there are periods of time when the market favors certain areas of the market, like large companies or say commodities or bonds, and it's very difficult to be able to time exactly when markets shift from favoring one area of the market to another. So we want to own more of those strategies, and when they do have disparate returns, we want to take advantage of that and rebalance. And really what we're trying to do there is the old adage of buying low and selling high. We want to find those asset classes that have recently outperformed, that are trading at relatively high prices. We want to sell those that have become overweighted in the strategy, and we want to buy those areas that have underperformed, that may be trading at lower prices, so that we can take advantage of the disparate moves in the different asset classes. So we started this strategy in 2001. Our goal was mainly to give clients the ability to access markets broadly across the world. Again, invest in multiple different asset classes so that they would have a diversified portfolio. Really, the strategy was based on an equation that we really think is true about how investors capture returns. And really, an investor returns is simply equal to the market returns that are available minus the costs and the frictions associated with those owning those assets, and then plus or minus the investor's behavior. And so we knew that we wanted to go capture broadly market returns that are available to investors worldwide, as long as they stay invested and they're there to capture those returns when they're available. We wanted a strategy that had fewer frictions and fewer costs. So we ensured the way that we owned those assets were utilizing lower cost solutions, solutions that had less turnover, less trading costs, less tax costs. And then we wanted to make sure that we had the correct execution on the strategy so that our behavior in owning those asset classes was actually additive to the returns. So by behavior, we mean how consistently and disciplined are we with holding those assets and managing them. And that really comes back to the rebalancing of the strategies of the asset classes all together within the strategy. And so we want to capture broad market returns. We want to do it with relatively little friction and little cost. And then we want the behavior of our management of the strategy to be additive to returns. And by holding a disciplined strategy and maybe holding assets when they may be out of favor, maybe selling assets when they're very much in favor, that may seem counterintuitive, but over time, studies have shown that we should capture a rebalancing bonus by selling assets that have done well and by buying assets that have underperformed. And that's a way that we can add to the return of the strategy. I hope this was informative for you. We do have other videos on our website that you might find helpful and might generate questions that you might ask either our investment team or one of our advisors. Thank you for watching and hope you have a great day.